morning, everyone. I'm Mark Dutram with BayView Private Wealth, and we're coming to you in early August. And I thought I would do this topic basically because of all the questions we're getting from clients and certainly economists pondering, are we facing a recession right now, or are we just merely experiencing market correction? So at this point, I think I'm more in the latter camp, that we're in a correction, but I'm going to share with you why. But from a historical perspective, if you look at market corrections, they're quite natural. They're quite, expected. In fact, the average intra-year decline for the S&P 500 over the last 45 years is about 14%. And so what that means to you is, again, whether the economy was good or bad, your $1 million essentially turned into $850,000. And I mean, that's a lot of volatility. But given this kind of context, the recent market fluctuations might seem less alarming and probably a little bit longer overdue with regards to how far we've come. I think we've been a little bit spoiled because, again, over the last 5 years, we've only seen 2 years with a correction greater than 10%, and one of them was COVID-related. So we've gotten a little bit spoiled, and I think the current multiple expansion that we've experienced really couldn't be justified, especially when you think about all of the uncertainties that we face today. So let me share with you why I think this might be a correction at this point. And let's start by looking at the economic indicators right now. And if we looked at consumer spending and business spending, it remains really strong, or certainly positive, with a year-to-date number for like consumers at 1.6%. If you look at business, fixed investment is up about 3.6% through the second quarter. And these figures kind of highlight continued confidence and activity in the economy. Remember, 70% of GDP is the consumer. If you looked at the ISM indexes, the ISM services, employment, new orders, and PMI indexes are all back above 50 now for July. Remember, 50 is kind of expansionary and kind of healthy as far as a level of economic activity. Even if you looked at the S&P, which is having, again, a lot of volatility, that with certainly all of the indexes, it's still up about 9% year to date. And earnings per share growth is tracking a solid 11% gain year over year through Q2. So this demonstrates a pretty resilient equity market. And I think so far, even in this earnings season, 78% of companies have reported, a surprise to the upside on earnings per share estimates. If we look at GDP and employment, GDP growth, again, came in higher than expected, 2.8% in Q2. But it's projected to slow, right, to about 1% for the remainder of the year. But it's important to note that it's not negative. And again, we knew that eventually all of the tightening that we've seen from the Fed would eventually have some impact. And we've seen some cracks for quite some time as we've been sharing with you guys. The headline numbers were not when you peel back the onion and look underneath. And even employment, that was kind of the straw that broke the camel's back, where people saw employment numbers. They weakened below expectations, but they still added, I think, 114,000 jobs last month, which, again, it's still growth, right? It's still adding new jobs, and that should continue through the balance of 2024, and that should keep, again, the current unemployment rate fairly stable. Other factors that would support the notion of a correction as well would be productivity and wages. Productivity growth is solid, 2.7% year over year, and that allows for kind of non-inflationary growth. Moreover, average hourly wage growth is kind of moderating, and I think now it's around 3.6% year over year, and that's the lowest since 2021. And this is what kind of allows us to manage inflation and still maintain some purchasing power. And if you look at energy prices and inflation, slower projected economic growth should help bring down energy prices in the future. And this, of course, aid the Fed in its efforts to kind of steer what we call PCE, or personal consumption expenditures, toward its target of around 2%. But, again, we do have a ton of challenges that we still face today. And these are things that could lead us into a recession, right? So we look at our recession indicator. It's in I think 58 today, which is not, again, negligible. But, we certainly have the impact of rate cuts. Initially, rate cuts can hurt the economy. So they reduce kind of consumer interest income that they were getting more than the interest expenses that they enjoyed or that they paid. And this could actually undermine confidence. So sometimes you see this kind of wait and see mentality that can also emerge, and businesses kind of hold off on borrowing. They kind of hold off on any kind of activity waiting for, further rate reductions. Global competitiveness, again, a declining U.S. dollar driven by the rate cuts generally make U.S. goods more competitive globally, but it could also destabilize markets if it's really not managed carefully. Monetary policy, if rate cuts slow consumer business spending, again, in other words, if it changes people's behavior, consumers don't act the same, business don't act the same, the economy could be pushed into a recession because it has such a big part of GDP. And of course, this complicates the Fed's, task of easing monetary policy effectively. I love, with the Olympics going on right now, I love the analogy of a runner. If you got a distance runner, he needs to drink and he needs to eat long before he is thirsty or hungry. Otherwise, it's going to be too late. And I think the same is true for monetary policy. Ideally, policy should be neutral, right? Just allowing market forces to work and to drive, again, the economy. But the Fed, when it's trying to either provide assistance in some way, it shouldn't be too loose, like I think it was for too long, or it shouldn't be too tight, like I think it is right now, which kind of instigates greater swings in the economy. And it should be early in its delivery of these adjustments. Otherwise, again, it could be too late. And that's kind of the fear I think that's come over the market now. Is it going to be too late? And is it going to actually cause a recession by being, where it's at today? As a part of our investment philosophy, we always evaluate portfolios, particularly for assets with very high valuations. And as we've seen historically, in the event of significant market pullbacks, those are the assets that tend to correct the most, right? So paying attention to price, a mean reversion, typically happens over time. And sometimes, again, that's just markets correcting themselves and taking all the collective data into effect in pricing them. So while there are many, potential risks that could push the economy into a recession today, I think the prevailing evidence suggests that we're likely experiencing a market correction. And that's what I really want to convey with you today. If you look deep down into the data, it's still quite positive. And that's why, again, we got to remain vigilant. We got to remain adaptable. And then we can kind of navigate these challenges and even leverage the opportunities that arise during periods of economic adjustment. So I hope, again, this has brought some light to where we are today. And again, we value you guys. I hope you're having an awesome day, and we wish you all the best. Thanks.